I think there's a real opportunity for Palantir to change the world. But before we get into that, let me tell you why Palantir is one of the best performing stocks in recent history. And then I want to talk about whether the stock will continue going up or if it's going to crush. So let's get into it. Palantir has gone up over 2,100% in 3 years. What's behind that growth? Can the momentum continue, or is it going to crash? To answer that question, let's do a full breakdown of Palantir Technologies PLTR across the dimensions of 4 business model: financial metrics, valuation, and strategic positioning. Let's dive in. Business model. Palantir operates on a 3-phase model: acquire, expand, and scale. Acquire offers low-cost or free initial deployments to attract clients. Expand customizes solutions to solve specific operational pain points. Scale embeds its platforms deeply into client workflows, increasing contract size and stickiness. Its revenue comes from government contracts, for example, U.S. military, CDC. Commercial clients, for example, healthcare, finance, manufacturing, software subscriptions via its platforms, Gotham intelligence, Foundry enterprise data, and Apollo deployment infrastructure. Management. Palantir has a unique management style that blends business acumen with an almost philosophical approach to technology. CEO Alex Karp, co-founder, known for his philosophical approach to tech and strong stance on ethical AI. Chairman Thiel, co-founder, influential investor and strategist. The leadership team blends deep government ties with Silicon Valley innovation. Customers. Palantir serves a diverse array of clients, each leveraging the platform's unique capabilities to enhance operations and decision-making. Government agencies: U.S. Army, CDC, NHS, UN World Food Program. Commercial clients: Airbus, Merck, BP, and recently Societe Generale and Wendy's. Average revenue per customer: $6.5 million. Palantir PLTR is scaling its customer base through a multi-pronged strategy that blends AI innovation, ecosystem integration, and global outreach. Here's how they are redoing it. 1. Launching AIP artificial intelligence platform. Palantir SAP is a game changer. Allows enterprises to deploy AI agents securely within their existing data workflows without compromising governance or compliance. This platform is modular, can plug into existing systems, secure, built with audit trails and encryption, scalable, designed for full enterprise rollout, not just demos. AIP is helping Palantir move beyond government contracts and into mainstream commercial adoption. 2. Expanding globally. Palantir is aggressively targeting international markets: Europe, NHS in the UK, energy and logistics firms in Germany and France, Asia-Pacific, partnerships in Japan, Sampo, South Korea, and Australia, Middle East, infrastructure and energy analytics deployments. These deals are not just symbolic, they're operational with real revenue impact. 3. Partnering with cloud giants. Palantir is integrating its platforms with major cloud ecosystems. Collaborations with AWS, Microsoft Azure, and Google Cloud. This allows customers to use Palantir's tools within environments they already trust, reducing friction and boosting adoption. 4. Targeting commercial mid-market. While Palantir started with large government and enterprise clients, it's now offering AIP bootcamps to onboard mid-sized businesses, lowering entry barriers for startups and growth-stage companies. Focusing on expansion within existing accounts, over 40% of new bookings come from current customers scaling up usage. 5. Customer growth metrics. Total customer count rose to 711 in Q4 2024, up 43% YoY. U.S. commercial customer count grew 65% to 432. Net dollar retention rate, 120%, meaning existing customers are spending 20% more than last year. Palantir's strategy is no longer just about winning big contracts, it's about building a sticky, scalable ecosystem that embeds AI into the core of enterprise operations. Now let's switch gears and discuss Palantir's financials, touching upon key metrics like revenue growth, profit margins, EPS growth, return on equity, and the debt-to-equity ratio. We'll also explore valuation, including the PEG ratio and Peter Lynch's formula. and conclude with my assessment of Palantir's potential for future growth and its current valuation. Revenue growth. In the second quarter of 2025, Palantir achieved impressive growth. Q2 2025 revenue, $1 billion, up 48% YoY. 5-year average growth rate, 23.3% annually. Revenue growth. Palantir has grown revenue consistently, nearly doubling from 2021 to 2025. Profit margin. After years of losses, profitability has arrived. Net margin, 22.18%. Operating margin, 26.83%. Gross margin, 80%, which is extremely high for a software company. Profitability. PLTR turned profitable in 2023 and has expanded margins significantly. EPS growth. EPS has mirrored revenue growth, moving from negative to positive territory. Trailing EPS, 30 cents, up 143.6% YoY. Has grown from negative to 33 cents in 2025, a sign of operational maturity. Return on equity. ROE demonstrates strong capital efficiency. ROE, 15.2%, showing strong capital efficiency. Return on equity flipped from negative to double-digit positive. Debt-to-equity ratio. The company maintains a very low leverage, indicating strong balance sheet discipline. Debt-to-equity, 0.04 PEG ratio. The PEG ratio suggests that the stock might be overvalued. PEG ratio 5.25, which is considered high, suggesting the stock may be overvalued relative to its growth. Fair value using earnings. Using Peter Lynch's formula, which is suitable for mature companies with steady earnings growth, the fair value is below the current price. EPS, 32 cents, capped earnings growth rate, 25%, assuming a mature company with limited downside. Fair value equals $8.05 per share. Current price, $156.71, gives overvalued by 95%. Fair value using discounted cash flow DCF. The DCF model values the company based on its future cash flows. DCF-based fair value, $19.11 per share. Current price, $156.71, gives overvalued by 88%. Investor lens. Palantir is a high-growth, high-premium AI play with strong fundamentals, but a valuation that's stretched by most models. Company's deep entrenchment in government and commercial sectors, combined with its expanding AI footprint, makes it strategically compelling, but investors should weigh the valuation risk carefully. To sum it up, Palantir has seen impressive growth over the past few years, but the real question is, can this growth continue? The company's forward-looking approach to business, strong leadership, and focus on innovation position it well for continued success. However, it's essential to consider both the opportunities and challenges ahead. One of the biggest opportunities for Palantir is the growing demand for AI-driven solutions across various industries. As more businesses look to leverage AI, Palantir is well positioned to capitalize on this trend due to its advanced platforms and experienced workforce. Moreover, Palantir's global expansion efforts are opening up new markets and partnerships. It's contributing to its impressive growth trajectory. On the challenge side, competition in the tech industry is fierce, and Palantir must continue innovating to stay ahead. Additionally, while its current valuation may seem high, it reflects the market's confidence in the company's future prospects. Looking ahead, Palantir's future growth will depend on its ability to execute its strategy, manage challenges effectively, and maintain its competitive edge. The company's track record so far is promising, but only time will tell how it will navigate the complexities of the tech market in the years to come. If you enjoyed this video, check out this breakdown of another amazing company. And if you really love these detailed analyses, hit that subscribe button. Thank you so much for watching. I truly appreciate it.